Okay, good morning to all students. Good evening. Okay, in this session, we are explaining the suggested answers of cost and management accounting, CMA intermediate, means cost and management accounting and financial management, CMA intermediate, group 2, recent examination paper of July 2023. Previous part 1. We already covered true, false, match the following, and MCQ questions. In this session, we are covering the long answers or descriptive questions. Okay. So, this is the first video in which we are covering the entire question paper solutions. So I am the first faculty from India who is uploading the video on suggested answers on complete cost and management accounting financial management paper. Reason is this paper is not very easy. 30 to 35% paper is very challenging paper. I can say 40% paper is very challenging paper even for faculty members also. In some areas some tricks will be there where we have to use some assumptions. This is the reason key this is not very simple paper. So 60% part is manageable, 40% part is challenging paper. Okay. So this is the part 2. Part 1 already uploaded on YouTube. You can see and you can watch. So part 2 we are covering the long answers or answers for the descriptive question. So here also I am covering the complete solutions of your section part A. Section 1 part A means cost and management accounting and financial management also. In some places alternative answers are also possible because of changes in the assumption. So that is also given in these solutions. Students have to watch and they have to like this video if they are understand all the points clearly. And important thing is what? Students have to subscribe for new videos. And next thing is what? I am providing my number also. If any student is having doubts, queries, then they have to WhatsApp on that number. So we will respond. Or for any other information, you can contact to the academy. Clear? So without wasting time, now we will start. So previous session already we covered section 1 of part A. You can watch that. Now we are covering section 2. So section 2 is on cost and management accounting. We'll start. So GYC Limited provides you following information. Year 1, Year 2. Year 1 loss 40,000, cost 108% of sale. Year 2 cost 11,40,000, profit 24% of sale. During the next year 3, the selling price and variable cost are expected to be reduced by 20% and 33 1/3% respectively, and fixed cost expected to increase by 25%. So estimate these sales so as to earn a return of 30% on capital employed. Working capital is 25% of sale and 20% of capital employed. So this question is on marginal costing, CVP analysis, change in profit by change in sales concept. But the new point which is added in the question is this particular point. Means return 30% on capital employed and working capital is 25% of sales and 20% of capital employed. These are the new points added in the question. So because of that, some working is required. Otherwise, any student who having the knowledge of these points, who have learned ratio analysis topic perfectly, they can manage this. Okay. Otherwise, they can stuck here. So we'll start. So first we have to calculate whatever inputs are required, that we have to calculate through working notes. Understand? So loss is given, cost is 108% of sale. Okay, so already students know ki cost, sales minus cost is loss. Sales minus cost is loss. It means here sale is 100%, cost is 108%. Because of that, loss coming. Here cost given, profit not given. So profit is nothing but what? 24% of sales given. So cost plus profit is sales. Cost plus profit is sales. So sales not given in year 1 also, year 2 also. So that can be considered as X. That can be considered as X. So see here. Okay, it means directly on paper I cannot solve this. That's why clear explanation is required. So you can watch this. So year 1, year 2, sales is X you can take or 100% you can take. 100%, 100%. So total cost in year 1 is 108%. And second year profit is given, that is 24% of sale. It means in first year what is missing? First year they have not given the loss figure. Second year they have not given the cost figure. So first year your loss is 8%. Second year your cost percentage is 76%. Your cost percentage is 76%. Now this 8% loss value is given in the question. So this 8% loss value is 40,000. So this is loss. This is 40,000. And 76% cost value also given in the second year. So 76% cost value is 11,40,000. So 76% value is 1140. So what is 100% value? So 100% value is 15 lakhs. Similarly, year 1, 40,000 is 8% value. So what is 100% value? 5 lakhs. That's it. So this is sales. So sales for year 1, 5 lakh. Year 2, 15 lakhs. Cost, 5,40,000, 11,40,000. So profit will be 40,000 loss in first year. Second year profit is 3,60,000. Now you can use change in profit by change in sales formula. You will get PV ratio. So PV ratio, change in profit by change in sale. So 3,60,000 minus 40,000 divided by sales difference is 10 lakhs. Okay. So 3,60,000 minus 40,000. So 4 lakh divided by 10 lakh, 40%. Now fixed cost. Fixed cost is what? Contribution minus profit. So PV ratio is 40%. So sales into PV ratio is contribution. So sales into PV ratio contribution minus profit 3,60,000. So fixed cost 2,40,000 coming. But in question they have made some changes here. What changes they are making? Means selling price and variable cost is reduced by 20% and 33 1/3%. And fixed cost increased by 25%. This is the changes required. Now by making these changes, you have to calculate new PV ratio. You have to calculate new PV ratio. So new PV ratio is new selling price minus new variable cost by new selling price into 100. Now suppose existing selling price is 100, for example. So in this 20% reduction is taking place. So new selling price will be 80. Similarly, suppose variable cost is means 60%, because previously PV ratio is 40%, so variable cost will be 60%. 1 minus PV ratio is variable cost ratio. The variable cost is 60%. So from this 60%, it is 60 rupees. In terms of rupees, it will be 60. So on this 60 rupees, 33 1/3% is reduced. So it means 33 1/3% of 60 we have to decrease. So 60 minus 33 1/3% of 60 is 20. So new variable cost is 40. Now we have to calculate new PV ratio. So new PV ratio is 50% coming. How much coming? 50% coming. I hope this calculation is understand. Yes, sir. So previously, before making the changes, your PV ratio is 40%. Now after making the changes, your PV ratio is 50%. That's it. Now new fixed cost, because fixed cost is also changing, 25% increase. So previously 2,40,000. Now in this 2,40,000, 25% increase. So 3 lakh rupees. Now we have to start the main solution. Now sales will be considered as X. Working capital is what? 0.25x means 25% of sales. And working capital is 20% of capital employed also. So working capital by capital employed is 20%. Because working capital is 20% of capital employed. So if capital employed is 100, working capital is 20%. Okay. So means working capital by capital employed is 20% given relationship. So working capital by capital employed is 20%. Already working capital is given here 0.25x. So 0.25x by capital employed is 0.2. So capital employed will be 1.25x. So capital employed will be 1.25x. Now desired return on capital employed is how much? Desired return on capital employed is 30%. Now on capital employed we have to apply this 30%. So 30% of 1.25x is 0.375. So this is your desired profit. Now in marginal costing CVP analysis we have one formula, that is sales required on desired profit. So use that formula. That is what? Fixed cost plus desired profit by PV ratio. So fixed cost plus desired profit by PV ratio. So fixed cost, new fixed cost plus desired profit by new PV ratio. So desired sales is X. New fixed cost already we calculated 3 lakhs. Desired profit 0.375x. PV ratio 50%. So X into 50%, 0.5x is equal to 3 lakh plus 0.375x. So 0.125x is 3 lakh. X is 3 lakh by 0.125, 24 lakhs. So answer for this question is 24 lakh rupees. Answer for this question is 24 lakh rupees. So answer is 24 lakhs. I hope this is understand to all students. Question is not very tricky. This is the important area. Okay. Any student who is having the conceptual knowledge of CVP analysis and ratio analysis, that student can easily crack this question. Chaliye, now we'll start the next question. Next question is also on CVP analysis. This question is on break-even point. Okay. So question number 2A already completed. Now we are starting 2B. So question number 2B is question on break-even point. This is on overall break-even point and product-wise break-even point. It means first we have to calculate overall BP, then product-wise BP. It means in some cases company will manufacture 2-3 different types of products. So in that case they will maintain one sales mix. Okay. Means what should be the sales proportion for product 1, product 2, product 3, like this. So in that circumstance we have to calculate break-even point on overall basis, then product wise also. So whenever this type of questions will be given, sales mix, product wise data, and we have to calculate BP, first we have to calculate combined PV ratio or combined contribution. So in order to calculate combined PV ratio or combined contribution, we have to multiply with sales mix. Contribution is multiplied with sales mix. Then we'll get combined contribution or weighted contribution. Understand? Really. So easy question. This is manageable question. First question is also not very tricky. Only one point is new given. So this is very simple question. B question. K Limited manufacture 3 products XYZ. The unit selling price 50, 30, 20. The corresponding variable cost ratio 20%, 30%, 50%. Total fixed cost 59,83,000. Required. Calculate overall PV ratio if proportion quantity wise in which these products are manufactured and sold is 20%, 30%, 50%. So this is sales mix given. Second point, again calculate overall contribution per unit. So first we have to calculate from PV ratio, then we have to calculate from contribution per unit. Okay. So here we will use ratio, here we will use contribution per unit. Mix is same, mix is not changing. So first we have to calculate combined or weighted PV ratio. In second point we have to calculate combined or weighted contribution per unit. That's it. So first what is selling price given? 50, 30, 20. What is variable cost ratio given? 20, 30, 50. So 1 minus variable cost ratio is what? PV ratio. So PV ratio is what? 1 minus variable cost ratio. So we have to calculate PV ratio first. PV ratio equals to 1 minus variable cost ratio. Okay. So after calculating the PV ratio, we have to multiply with this sales mix. So we will get overall PV ratio. We will get overall PV ratio. Understand? See here. The statement of weighted contribution. X, Y, Z, 3 products are there. Selling price per unit 50, 30, 20. Variable cost is 20%, 30% and 50% of sales. So I calculated variable cost here. So 15 to 20%, 13 to 30%, 20 into 50%. So 10, 9, 10. Okay. So 40, 21, 10 is contribution per unit. Now this contribution per unit is multiplied with sales mix. Contribution per unit is multiplied with sales mix. Okay. See, sales mix is 0.2, 0.3, 0.5. Here 2 points are given. First is overall PV ratio we have to calculate. Then contribution per unit we have to calculate. Okay. Understand? So calculate the overall PV ratio if proportion is 20, 30, 50. So PV ratio we have to calculate. In second part we have to calculate contribution per unit. So first I calculated contribution per unit here. Weighted contribution per unit here. Okay. Suppose if you want to calculate PV ratio, then in this way it will come. Sales mix 0.2, 0.3, 0.5. So PV ratio is what? 1 minus variable cost ratio. 0.8, 0.7, 0.5. So weighted PV ratio 0.2 into 0.8, 0.3 into 0.7, 0.5 into 0.5. Okay. Clear? So this is weighted PV ratio, overall PV ratio. This is weighted PV ratio or overall PV ratio. Understand? This is weighted PV ratio or overall PV ratio. Now we have to calculate overall break-even point. Overall break-even point. Okay. We have to calculate overall break-even point. Clear? So sales mix, PV ratio, sales mix into PV ratio, weighted PV ratio. Now overall break-even point, total fixed cost by weighted PV ratio. PV ratio formula is what? Fixed cost by PV ratio. So here overall PV ratio is 62%. So overall fixed cost by overall PV ratio, you will get overall break-even point. Overall break-even point. Now product-wise break-even point is required. So 20%, 30%, 50% is the proportion. So 96 lakh 50,000 into 20%, 30%, 50%. So you will get 1930, 28 lakh 95,000, 48 lakh 25,000. Selling price is 50, 30, 20. So 1930, 19 lakh 30,000 divided by 50, 28 lakh 95,000 by 30, 48 lakh 25,000 divided by 20. You will get BP in units. BP in units. So total BP quantity is 376, 350. So this is easy question. This type of question already we have covered in class. Okay. So I hope this is understand. Clear, sir. Now second part. Now we are starting second part. This is second part. This is second part. Okay. Second part is contribution per unit we have to calculate. Contribution per unit we have to calculate. So here we are calculating contribution per unit. So selling price per unit, variable cost per unit. Okay. Then selling price minus variable cost, contribution per unit. You have to multiply with sales mix. So weighted contribution per unit will come 19.3. So overall break-even point is total fixed cost by weighted contribution or overall contribution. So this is 3,10,000 units coming. Now product wise we have to break up 20, 30, 50. So 3,10,000 into 20, 3,10,000 into 30, 3,10,000 into 50. Okay, so 62,000, 93,000, 1,55,000. Now you can multiply with selling price. So break even point in units 62, 93, 155. Selling price 50, 30, 20. So BP in rupees will be 31 lakhs, 27 lakh 90,000 and 31 lakhs. Okay. So this is your break even point in rupees. So this is easy question, manageable question. I hope this is understand to all students. Yes, sir. Only we have to calculate what? Break even point in rupees and break even point in units. In one case we have to use PV ratio. In one case we have to use contribution per unit. That's it. So whenever 2-3 types of products given, along with that sales mix given, so weighted contribution will be used or overall PV ratio will be used, or weighted contribution per unit is used or overall contribution per unit is used. I hope students have understand this. Yes, sir. Chaliye, now we'll start question number 3A. This question is on budgetary control. Okay. This is a flexible budget question. So in this question, new points are given by the institute. What are the new points? Material wastage. Material wastage is not a new point. Already we understand this in first part. Okay. New point is what? Expected increase in the labor productivity. See, when labor productivity increasing, time taken by labor will decrease. Obvious na? Efficiency increasing. So on one unit, how much time labor is spending, that will decrease. So because of that, hours will decrease. What will decrease? Hours. Labor hours will decrease. So this you will understand in direct labor chapter. So this is very good question actually. So examiner is testing direct labor knowledge also. If any student who is having good knowledge on direct labor, that student can easily understand that whenever efficiency increases, obviously he will take less time to produce the units. Okay? Yes, sir. And whenever wastages are taking place, then material cost will increase. We have to produce more number of units, and from that some units will be defected. Ultimately net production will reach. Yes, sir. So this is the new point. That's it. Remaining is manageable question. If any student understand these 2 points, he can easily solve this question. Yes, sir. What is required? See. So material and labor requirement is given. Direct material 5 rupees per unit, 1.9 unit means to produce 1 unit they have to consume 1.9 units. To produce 1 unit they have to use 2.4 hours of labor. This is the requirement for 1 unit. Wastages 5%. Expected increase in productivity 25 means this is increase in efficiency. So at 80%, 60% they have given the data. Production overhead including depreciation, administration overhead, selling and distribution overhead, sales. So first we have to check these 2 totals are same or different. These 2 totals are same means that is fixed cost. If this is not same means it can be variable also, it can be fixed also. Sorry, semi-variable. So if 2 totals are same means fixed. This is fixed cost. This is fixed cost. So here only one item is 100% fixed. That is depreciation. Now this can be semi-variable or variable. This can be semi-variable or variable. Now we have to separate. We have to separate variable part, fixed part. Because this is semi-variable, this is also semi-variable, this is also semi-variable, this is also variable. How I am deciding this is semi-variable? 1 minute, I will explain that. See, first your sales is how much? 32 lakhs and 24 lakhs. So 32 lakhs divided by 200, you will get number of units sold, produced and sold. Here also 24 lakhs divided by 200, you will get number of units produced and sold. So first we will calculate this, number of units produced and sold. Okay, na? See here. Number of units produced and sold at 80% level, 32 lakhs by 200, 16,000. This is given actually in the question, 32 lakhs. Okay. So from this we can calculate for 50% also, 90% also. Okay. You can use any one base. Either you can use 60% base or you can use 80% base. So I have used 80% base. So at 80%, 32 lakhs is your sale. So this is divided by selling price 200 per unit. So 16,000 units are coming. How many units are coming? 16,000. So for 80% it is 16,000. So 50%, 90%, how much? So this will be 16,000 into 50 by 80, 16,000 into 90 by 80. So 10,000, 18,000. 10,000, 18,000. Similarly, if you calculate at 60%, it will be 16,000 into 60 by 80. 16,000 into 60 by 80. That's it. Now we have to prepare the budget for 50 and 90%. That's why this is important for me. Okay. Right, sir. Clear? Yes, sir. Now direct material cost. First I am calculating direct material cost. So budgeted production is how much? For 50%, 10,000. For 90%, 18,000. So 10,000, 18,000. Now direct material quantity required for every 1 unit, 1.9 requirement. So 10,000 into 1.9, 19,000. 18,000 into 1.9, 34,200. Okay. Yes, sir. So 19,000, 34,200 is total quantity of direct material required. Now wastage rate is 5%. So it means 5% will be wasted. So if you have to produce more number of units, whenever there is a wastage, you have to produce more number of units. So we need more direct material. We need more direct material. So this is 95% value. 19,000 is 95% value. 34,200 is 95% value. So 100% value. How much total direct material required before wastage? Before wastage, total how much direct material required? That only we have to purchase, na? Yes, sir. So this will be 19,000 by 95%, 34,000 by 95%. So 20,000, 36,000. Now we have to calculate cost. So we have to purchase 20,000 units at the rate of 5, 36,000 units at the rate of 5. So direct material cost is 1 lakh and 1,80,000. That's it. Now labor, budgeted production 10,000, 18,000. Direct labor hours required 2.4, 2.4. Total budgeted hours required 24,000, 43,200. Efficiency increasing here. So whenever efficiency increases, labor time will decrease. Time required for production will decrease. So 24,000 by 125%, 43,200 by 25%, because this is total hours, but efficiency increasing, so this will decrease. So after that, this is 19,200, this is 34,560. So it means the labor has taken 19,200 hours time for producing these units and 34,560 hours time for producing these units after 25% increase in efficiency. So labor cost is 5 rupees per hour. Now you can multiply 19,200 into 5, 34,560 into 5, that's it. 96,172,800. Yes, sir. Okay. Now overhead breakup required. What is required? Overhead breakup. Now production overhead. See, whenever the cost is variable or fixed, how to identify? See, 80% units are 16,000, 60% units are 12,000. First you have to divide this cost with 16,000 units, 12,000 units. If per unit is same, means this cost will be divided by 16,000 because 80% units are 16,000 and 60% units are 12,000. So this cost should be divided by this 12,000 and this cost should be divided by 16,000. If per unit is same, means it is variable. If per unit is same, it is variable. It means 5.224 divided by 16,000, and here 4.768 divided by 12,000. If per unit is same, this per unit and this per unit is same, then it will be variable. But here it is not coming same. That's why it is not variable. This is semi-variable. Because it is not amount wise also same, per unit wise also not same. If amount wise same, fix. Per unit wise same, variable. Amount wise also not same, per unit wise also not same. So it will be semi-variable. Yes, sir. Amount wise also not same, per unit wise also not same. So it is semi-variable. So whenever semi-variable cost is there, we have to use this formula for calculating the variable part. So variable cost per unit will be change in cost by change in output. Change in cost by change in output, change in quantity. So we have to use this formula. So we'll get variable cost per unit. Then we can break up fixed cost and variable cost separately. We can break up fixed cost and variable cost separately. Actually, so we'll start now. So first production overhead. So change in cost by change in output, variable cost per unit will come. So this is 5.224 now. So I'm writing in lakhs. So 5,22,400. This is 476,800 divided by 16,000, 12,000, because 60%, 12,000 units coming. So 80% cost, 60% cost difference divided by 80% cost, 60% cost quantity difference. So 11.4 per unit coming. So we have to calculate fixed cost now. So total cost at 60%, 80% is 476,800, 522,400. From this we have to deduct variable cost at the rate of 11.4. It means 12,000 into 11.4, 16,000 into 11.4, because units in 60% is 12, 80% is 16. So this is multiply with 11.4. So deduct this, you will get fixed cost. So fixed cost must be same in both. Right, sir. Similarly, for variable administration also, production completed now. So for administration, 60% level cost is 368, 80% 384. So per unit is 4 coming. So variable cost is 48,064. Fixed cost is 320. Now selling and distribution also, change in cost by change in sale. So 60% level 360, 80% level 380. Units difference 4,000. So 5 rupees per unit coming. So variable 60/80, fixed 3 lakhs. That's it. Now we can prepare the budget here. So first sales, I am using marginal costing approach in budget because I am calculating the contribution first, then I am deducting fixed cost. So sales units 10,000, 18,000, 50% level, 90% level, selling price 200. So sales value is 20 lakh. This is in lakhs. So 20 lakh, 32 lakhs. Now variable cost of sale, direct material 1 lakh, 1,80,000. Working note 1 lakh, 1,80,000. Okay. This is working note 1. This is working note 2. Okay. Now direct labor 96,000, 172,800. So 9.96, 1.728, because this is in lakhs. Next, production overhead. Variable is 11.4 per unit now. How many units? 10,000. 10,000 into 11.4, 18,000 into 11.4. Divided by lakh, so 1.14, 2.052. Similarly, administration overhead variable part 4. So 10,000 into 4, 18,000 into 4, divided by lakh, 0.4, 0.72. Selling and distribution also 10,000 into 5, 18,000 into 5. So divide by 1 lakh, so 0.5, 0.9. So variable cost total is 4, 7.2. Sales 20, 32. So sales minus variable cost, contribution coming 16, 28.8. Now fixed cost. In fixed cost, production overhead, administration overhead, selling and distribution overhead. So production overhead variable is 136,800. Fixed is 3,40,000 at 60% level. 80% level variable is 182,400. Fixed is 3,40,000. Okay, so fixed we need. So fixed how much? 340. And depreciation also given now, because variable already we have taken. Now we need fixed. So fixed 340. And depreciation is also given, fixed cost. This one. So this depreciation is also included in production because this is related to production. Yes, sir. So 3,40,000 and 0.4. 3,40,000 and 0.4 means 3.4, 0.4. So this is just 1 minute. So already including depreciation given, right? So already including depreciation given. So directly in this depreciation is included. So from 3.8 we have to deduct 0.4. So 3.4. Okay, so 3.8 minus already depreciation included now. So minus 0.4. Or you can do directly one thing. Directly 3.4 you should write. Directly 3.4 you should write. Suppose if it is not included, so we have to add separately. Already depreciation is included here. So directly depreciation included means 3,40,000 only is your production overhead. That's it. So 3.4 will come. So 3.4, 3.4. So 3 plus 0.4, 3.4. Because including depreciation. Administration overhead fixed how much? 320. So 3.2. Selling and distribution 3 lakhs. So 3. So here 3.2, here 3 will come. 3.2, 3. Fixed cost. So contribution minus fixed cost. Profit. That's it. So it's not very difficult question, manageable question. Not very difficult, manageable. Only challenge is what? This point. Here students will make the mistake. This is the speed breaker of question. Wastage they can understand because in production budget we will cover this point and we will cover this point also in direct labor. So any student who is having good knowledge in direct labor, he can done this question in 100% correct. Otherwise mistake is possible from this area. So gross production and according to that material cost we have to calculate. Then because of increase in efficiency, labor time will decrease, so cost will also decrease. Cost will also decrease. So ultimately the answer for your this question is 6.4 and 19.2, profit at 50%, 90%. See, these answers are 100% authentic answer. No mistake in this, 100% correct answers. Because at each and every place I have taken reasonable care while preparing this video. So 100% authentic correct answers are there in all practical problems. Right, sir? So now we'll start next question. So next question is on control ratios. This is easy question. Only one new ratio is given in the question. This one. Okay. Remaining already we'll discuss in the classes and always we solve the problems. So one company is manufacturing two types of product X and Y. Product X required 5 hours to produce, while Y 5 units of Y can be produced in 1 hour. So in 1 hour 5 units produce, X required 5 hours to produce. See, in 1 hour 5 units are produced. In 1 hour 5 units are produced. This is different. In 5 hours X required 5 hours to produce. Means 1 unit of X 1 unit is produced in 5 hours. X 1 unit is produced in 5 hours. Okay. Now Y 5 units are produced in 1 hour. In 1 hour. Okay. Clear? So here time requirement is 5 hours for X per unit. 5 hours per unit. In case of Y, this is in 1 hour they are producing 5 units. So this is 1 by 5 hours. 1 by 5 hours per unit. 1 by 5 hours per unit. Right, sir? Understand, sir? So in July, 24 effective working days of 8 hours a day 3,000 units of X produce, 15,000 units of Y produce. Okay, so we have to calculate the time now. So this is 3,000 into 5, 15,000. Now this is 15,000 into 1 by 5, 3,000. This is time. 15,000 hours, 3,000 hours. So total time is 18,000 hours. Total time is 18,000 hours. The company employ 100 workers to produce X and Y. There are 25 working days in budget. Maximum possible hours is 24,000. So budgeted number of days are 25 and budgeted hours, maximum possible hours 24,000. And the company is employing 100 workers. That's it. So we have to calculate efficiency, activity, capacity, calendar, idle capacity. Idle capacity is nothing but 1 minus your efficiency ratio. How efficiently they are working. Okay. Standard capacity usage ratio, actual capacity or actual usage of maximum capacity ratio. This is the new ratio which is given in the question. Remaining manageable, we'll discuss in the classes regularly. This is also not new. Examiner is testing the ability of the student ki if new point is given, they can judge and solve correctly or not. Chaliye, so we'll start the solution now. So actual hours, 100 workers are working, 8 hours every day they are working, 24 days they are working. So 19,200. Budgeted hours, actual hours, only one difference, number of days change. In actual, number of days are 24, in budgeted, number of days are 25. This is the change. According to that, 20,000 hours coming budgeted. Now, when we calculate the control ratios, we have to calculate standard hours for actual output also. Standard hours for actual output also, because this is used in efficiency. So standard hours for actual output. So this is actual output into standard time. Already I explained here. See, 15,000, 3,000, 18,000. So this is 18,000 hours. How much? 18,000 hours. I hope students have understand this point. 24 days difference, 25 days. This is budgeted. And this is already explained. This is also explained. 18,000. How much? 18,000 is coming. This is. Okay. Now efficiency ratio. Already see, when you learn fixed overhead variances, what formulas you will use? The same formulas here used in percentage form. Like absolute measure is used in your fixed overhead variances, means standard minus actual. Okay. So in control ratios, relative measure is used. Standard by actual, budgeted by actual, like this. You have to divide to calculate the ratio. That is the only difference. So efficiency ratio formula, what you use? Standard hours for actual output minus actual hours into fixed overhead rate per hour. Clear? You use that now, or per unit. If you are calculating in units, generally it is used in hours only, so you will multiply with hours. So here standard rate, actual rate, rates are not required. So rate will be not used in control ratios. That is the only change. So directly standard hours by actual hours. The standard hours for actual output is 18,000. Actual hours are 19,200. Efficiency ratio is 93.75%. Okay. Next. The idle time variance means actually what is your capability. If your capability is 100, but you are working at 95% or 98%, so you are working less according to your capability. So from that we can calculate idle time. Okay, wait. Now activity ratio is what? Volume ratio. Activity ratio is what? Volume ratio. Right? So when you calculate volume variance in fixed overhead variances, when you calculate the volume variance in fixed overhead variances, what you will use? Actual output minus budgeted output. Actual output minus budgeted output. This you will use. So here also we use actual output, budgeted output. But here we have to multiply with hours. So actual output into standard hour, budgeted output into standard hour. So after multiplying this, it will become standard hours and budgeted hours. That's why the formula will be standard hours for actual output by budgeted hours. So standard hours for actual output by budgeted hours. Okay now? Yes, sir. So 18,000 by 20,000, 90%. Now capacity ratio. Actual hours by budgeted hours. Means according to budget, we have to work for 20,000 hours. But you are working at 19,200 hours only. So it means you are not working at 100% level. You are working at 96% level. It means 4% is your idle time. 4% is your idle time. Understand? Yes, sir. Now calendar ratio is what? Actual days by budgeted days. So 96%. Now idle capacity is what? 1 minus capacity, 4%. Now standard capacity ratio. Standard capacity ratio means budgeted hours by total possible hours. Okay, budgeted hours by total possible hours. Understand? So budgeted hours is how much? 20,000. Total possible hours 24,000. So this will give you standard capacity ratio 83.33. Actual capacity ratio is what? Actual hours by total possible hours. So actual hours is 19,200. Total possible hours 24,000. This is 80%. That's it. So 93.75, 90, 96, 96, 83.33, 80. So this is a manageable question. This is a manageable question. So it is not very tricky question. Actually, now we'll start next question. I hope this is understand. Now question number 4a. This is actually very tricky question. Very good question. Very good question. It is not time consuming question, but very good question. This type of question previously not tested in the institute. Even in CA examination also, or in CMA examination also. So first time they are testing this type of question. Okay. Means missing figure question already tested in the past examination paper. There is no doubt in that. But some changes have taken place in this question. That's why it is a new question. Right, sir. So this is on labor variance. This is on what? Labor variance. So actual number of workers are missing here. So this we have to calculate here. Ultimately what we have to do? Actual number of workers we have to calculate here. So max calculation will take place here. Skilled, semi-skilled, unskilled, total number of workers, standard rate, number of workers, actual rate. So standard everything is provided, but actual only rate given, number of workers missing. So standard output of gang is 12 units per hour. The gang engaged for 200 hours, of which 20 hours were lost due to machine breakdown. So you always remember, when a standard is prepared, generally abnormal idle time is not considered in the standard. So abnormal idle time will take place in actual scenario only. So abnormal idle time is not part of standard. So standard, it will not be considered. Okay, only it will considered in actual, because in actual only it will take place. At the time of preparing a standard, we don't know because of which reason hours can be lost abnormally. That will not be identifiable and predictable. That's why in standard there is no abnormal idle time. In actual only abnormal idle time will take place, because at the time of actual work only we face that. So this 20 will be deducted while calculating the actual hours. In standard there is no effect of this. So they produced 2,295 units. Now actual number of skilled worker was 2 times of semi-skilled. Total labor mix variance is 10,800. You are required to calculate actual number of workers. Okay. So first in this question, what is required? In this question, first we have to calculate standard output, then standard hours for actual output, then actual hours. Then we can solve the question. Okay, standard hours is not very much important also, directly also we can solve. Main is what? For labor mix variance, what is required? Revised actual hours worked minus actual hours worked into standard rate. This is the formula. Revised actual hours worked minus actual hours worked into standard rate. So we have to calculate actual hours worked first. We have to calculate actual hours worked. Actual hours work means from total actual hours, abnormal idle time is deducted. Abnormal idle time is deducted. So we will get actual hours worked. Worked means after deducting abnormal idle time. Okay. Chaliye. So generally I solve this question in completely, so that next time if examiner is testing other variances also, student can solve. So by that I solve this question. First, what is required for you, that I will explain. Thereafter I will explain full solution also. Okay, understand? Yes sir. See, first total actual hours worked. We have to calculate total actual hours worked. Total actual hours worked is what? Actual number of workers are 25. Yes sir. And they are producing 2295 units. How much they are producing? 2295. Okay. So this is important point here. So from this we can calculate. Okay. See here. Just 1 minute. 25 actual number of workers. Now for 2295 units, the workers have taken 200 hours time. So 200 hours into 25 workers. How much? This is 5000. But in this 20 hours is abnormal time now. So we have to deduct 20 hours. Actual hours paid is different. Actual hours paid is 200. Actual hours worked is 180. So we have to calculate actual hours worked. So 180 into 25. So this will be 4500. So this is total actual hours worked. So total actual hours worked is 25 workers into 180 hours, 4500. And we know the revised actual hours worked is nothing but total actual hours worked in standard proportion. Whenever we calculate labor mix variance or labor yield variance, we will use revised actual hours worked. So revised actual hours worked is nothing but what? Total actual hours worked in standard mix percentage or standard proportion. So it means total actual hour worked is 4500. So this should be break up in standard ratio. So you will get revised actual hours work. Revised actual hours work. So standard is already given in the question. Standard number of worker 12, 8, 5. So we have to break up this 4500 in this ratio. 12 by 25, 8 by 25, 5 by 25. That's it. You will get revised actual hours worked. Because actual hours work, revised actual hours work, same. Only difference is what? Actual hours worked in standard proportion is revised actual hours work. Yes, sir. So here, revised actual hours worked in nothing but what? Total actual hours worked in standard proportion. So 4500 in standard proportion. So skilled 2160, semi-skilled 1440, unskilled 900. So this is 12 by 25, 8 by 25, 5 by 25. Understand? This is the standard proportion. This is the standard proportion. So 4500 will be in standard proportion. So 2160, 1440 and 900. I hope this is clear. Now the formula for labor mix variance is what? The formula for labor mix variance is revised actual hours worked minus actual hours worked into standard rate. Now if you multiply this with this, so this is revised actual hours worked into standard rate, okay, minus actual hours worked into standard rate, okay. Revised actual hours worked into standard rate minus actual hours worked into standard rate. This is your mixed variance. So we have to calculate revised actual hours into standard rate also, actual hours worked into standard rate also. Yes sir, understand. Now I am calculating actual hours worked into standard rate. So in question they have mentioned one point here. What is mentioned? The skilled workers are twice of semi-skilled. Skilled workers are twice of semi-skilled. So it means semi-skilled workers are X. Semi-skilled workers are X. Semi-skilled workers are what? X. This will be X. So skilled will be what? 2X. Skilled will be what? 2X. So semi-skilled are X, so skilled will be 2X. Into rate 75, 50, 40. Yes sir. So total how much time they are working? 180 hours. So 180 hours into 2X into 75 rate. 180 hours into X into 50 rate. Okay. Now 180 hours. Now last total number of workers are 25. From this 25, skilled workers are 2X. Skilled workers are 2X. Semi-skilled are X. So unskilled will be what? Total 25 na? Total 25 minus 2X minus X, or means 3X directly you can deduct. 3X. Because 25 is total number of workers. From this skilled is 2X. Semi-skilled is X. So unskilled will be how much? 25 minus 3X. 25 minus 3X. Yes sir. Understand? Yes sir. So this is 180 into 25 minus 3X into rate how much? 40. This is standard rate. So 2700X, sorry, 27,000X, 9,000X. Okay. 180 into 25 minus 3X into 40. So this will be 3X into 40. So ultimately this equation is coming as what? 1,80,000 minus 21,600X. See, 180 into 25, 4,500 coming. Right, sir. Clear? Okay. See, 180, first you can multiply 25 into 40. And I am not multiplying directly with 40. I am using in last this calculation. First, within this bracket, whatever is there, I am using that. So 180 into 25. First I multiply, then 180 into 3X I multiply. So 180 into 25, 4,500. 180 into 3X, 540. Then again I multiply with 40. Okay. So 1,80,000 minus 21,600. So total 1,80,000, 27,000X, 9,000X is 36,000X minus 21,600X. So 14,400 plus coming. 14,400 plus coming. Now revised actual hours worked into standard rate. Revised actual hours worked already we calculated here, this one. Now this will be multiplied with the standard rate. Standard rate is 75, 50, 40. So 2,160 into 75, 1,440 into 50, 900 into 40. This is coming from here. Revised actual hours. This is 2,70,000. Now labor mix variance is what? Revised actual hours worked into standard rate minus actual hours worked into standard rate. This is adverse given 10,800, adverse given 10,800, adverse given. So 10,800 adverse is equal to 270 minus 1,80,000 plus 14,400. So minus 10,800 into 270 minus 180, 90,000 plus 14,400. So 14,400 x equals to 1,800 x is 7. So number of semi-skilled workers are 7 now. Semi-skilled workers, how much? 7. That's it. So semi-skilled 7. So skilled will be double of that. If semi-skilled is 7, skilled will be 2 times of semi-skilled. So 14. So 14 plus 7, 21 ho gaye. Now 25 total minus 21. Unskilled how much? 4. That's it. So this answer is completed. Now this is the final answer. Okay. This table I prepared for calculating all variances, but for your exam this is not relevant. From your examination point of view, relevant is from this course only, here onwards only. So number of workers will be 14, 7, 4. That's it. So this is your answer. So answer is 14, 7, 4. This is your answer. So this is your answer. And 100% correct answers. All questions 100% correct answer. No doubt is required in that. No doubt is required in that. Okay? Clear? Because of this toughest question paper only, means in some places question paper is tough, in some places this is manageable question. This is not very tough question. This is manageable question. If a student is having good knowledge about standard costing, that student can solve this. Chale, last question number 4B. Question number 4B. Okay na? Yes sir. Question number 4B. Actually, this is, in this question there is a error, or we need to use assumption here. So any student who is attempting this question and solving the question by making any assumption, okay, that student can get complete 6 marks. Because this question is having some error. What kind of error? They have not given in the question how to break up this semi-variable overhead. How to break up this semi-variable overhead, this is not given. So when this is not given, either we have to ignore this, or we have to break up according to our own assumption. So any student who ignore this and solve this question, that student can also get 6 marks. And any student who assume कि 27,000 I am breaking 60-40 ratio or 50-50 ratio, 75-25 ratio, that is also correct. Any ratio you can use, because examiner has not given how to break up this semi-variable. So when how to break up this semi-variable is not given, choice is with the student only. Either he can assume that this should be ignored, or he can use any ratio to break up that and he can solve. So any student who ignore this and solve the question, that will also get the mark. That student will also get marks. Or the student who break up this according to their own ratios by taking own percentages or own proportion, those students will also get marks. Only attending question is not required. Attending question with assumption required. You have to write key break up. How to break up semi-variable is not given, so it is ignored. Or we are breaking up semi-variable in this ratio, then you will get marks. Chaliye, we'll start now. See, solution. Information relating to segregation of budgeted semi-variable overhead is not given in the question. Therefore, problem can be solved by making the following assumptions. First assumption is what? Ignore semi-variable overhead given in the question. Ignore this and solve the problem. Second assumption is what? Fixed. Assume fixed and variable proportion. Means here I assumed 5/9 of semi-variable overhead is fixed, 4/9 semi-variable overhead is variable. This is my own assumption, bhai. Okay? Because from others fraction is coming, so I taken this proportion. So from this proportion, fraction figure is not coming. That's why I use this proportions. This is my own proportions. Examination condition student can use differently. Okay, so from both assumption, if question attempted, student will get the marks. Chaliye, now we have to, in this question, I followed second assumption. I followed a second assumption. Okay, this assumption I followed. Right, sir. So this is a question on fixed and variable overheads. Fixed and variable overhead. Chaliye. So semi-variable overhead, I assume 15,000 as fixed, 12,000 as variable. Means 5 by 9 fixed, 4 by 9 variable. Understand? This is my assumption. Right, sir. So accordingly, budgeted fixed overhead will be 75,000 and this 15,000. Budgeted variable overhead will be 18,000 and this 12,000. 75,000 is already given in the question. Okay, and this is also already given in the question. So in this, we have to add fixed portion and variable portion relating to semi-variable. Okay, na? Yes, sir. So first working is budgeted fixed overhead, budgeted variable overhead. So this is 90,000 and 30,000. 90,000 and 30,000. Okay, yes, sir. Now we have to calculate budgeted hours. So 25 days, 8 hours, 150 workers. Here given 25 days, 8 hours, 150 workers. Right, sir. Actual will be 26, 9, 132. Right, sir. 25, 8, 150 budgeted, 26, 9, 132 actual. So budgeted hours will be 25 days into 8 hours into 150, 30,000. Now output also we have to calculate. Output is 1 by 2. Means in 1 hour, half unit is produced. Here 1 hour, 1 by 2.2 units produced. So budgeted output is 30,000 into 1 by 2. Now budgeted variable overhead per hour, budgeted overhead by budgeted hours. So budgeted overhead is how much variable? 30. Budgeted hours how much? Budgeted hours how much? 30. So budgeted overhead by budgeted hours, rate 1 rupee coming. Now fixed overhead rate per hour, 90,000 by 30,000. So 90,000 by 30,000, 3. Now fixed overhead rate per day also required. 90,000 by budgeted days how much? 25. So 3,600. Because we will use this for calendar variance. We will use this for calendar variance. Okay. Now actual hours 26 days into 9 hours. Every day they are working and 132 workers. So 30,888. Now actual fixed overhead is what? 78,570 plus here how much given? 24,300 given na? 24,300 into 5 by 9. 24,300 into 5 by 9. And variable how much? 4 by 9. Accordingly 92,070, 26,070. Actual output is what? Actual hours into 1 by 2.2. 1 by 2.2. 14,040. Now data is ready. Budgeted actual. Output, days, hours, fixed overheads, variable overhead. Now variable overhead efficiency ratio. Variable overhead efficiency ratio. See, variable overheads are directly linked with labor hours. When labor hour means labor variances, what formula you use for efficiency, same formula will come here. When labor variances, what formula you use for efficiency variance? Sir, standard hours minus actual hours, okay, into standard rate. Same formula will come here. So standard hours for actual output minus actual hours into standard rate per hour. So standard hours for actual output we have to calculate. Okay, standard hours for actual output we have to calculate. See, for 15,000 units, budgeted hours how much? 30,000. So for 14,040 actual output, what will be your standard hours? That's it. See, 15,000 units, budgeted hours are 30. So for 14,040 actual output, this will be how much? This will be how much? So this is 28,080. 28,080. That's it. My standard hours, actual hours already available. This is actual hours. This is standard hours for actual output. Rate 1 rupee already we calculated variable rate in working note. So 2,808 adverse coming. Because 3 variances we have to calculate here. How many variances? 3. variable overhead efficiency, fixed overhead efficiency, fixed overhead calendar. So first I completed. Now fixed overhead efficiency, same, only rate will change. What will change? Rate. Standard hours for actual output will be same because there is no other information given. Only rate will change. Into 3 will come here. What will come? Into 3. That's it. So fixed overhead efficiency variance, only rate will change. 3 will come here. That's it. Remaining same. So 28,080 minus 30,888 into 3. So directly if you multiply with 3, fixed overhead efficiency variance will come because rate is changing only. 8424. Now calendar variance, actual days minus budgeted date into rate per day. Actual days 26, budgeted 25, rate 3600. So favorable coming. That's it. So in this question, the problem is data is incomplete. Because of this, student may be confused. So examiner will definitely give the marks here. Don't worry. Especially I will mail to the examination department. Otherwise it will be not justifiable. So definitely I will mail. Yes, sir. Any student who attempted this by using any assumption should be liberal in this area. They should give the marks. Chaliye, so this costing is completed now. Cost and management accounting is completed. So 2808, 8424, 3600 is your answers. First two answers are adverse because standard and actual is different here. So adverse coming. Okay. And here favorable coming. Chaliye. Now theory questions I am not discussing here because theory question can be available in any book. So from any book we can understand this. Only I will give the hint: break-even analysis, variance analysis, budget manual. Break-even analysis means what? Analyzing the break-even point in units, break-even point in rupees, okay, cash break-even point, okay, total break-even point, clear, multi-product break-even point, all this will come in this. Variance analysis means what? Analysis of variance through standards. So standard cost is generally compared with actual cost, or actual cost is compared with standard cost. Actual cost is compared with the standard cost. So if any deviation is coming, that is variance. So variance analysis is used for what? Cost control. For cost control. Then budget manual. Budget manual means what? In budgetary control, one manual is used. Through that manual, they will execute the performance and they will achieve the targets. So it is a book. It is a one type of means source. From that all activities will be recorded and executed in order to control the things and achieve the targets. So direct costing and marginal costing. See, in marginal costing and direct costing, the difference is what? In direct costing, only till prime cost items will come. In marginal costing, we will consider overheads also, factory overhead, okay, or any overhead which is variable in nature. In direct costing, generally any cost which is directly attributable to product or service, that will come. So department cost will not consider here, like production overhead, administration overhead, selling and distribution. But in marginal costing, all variable expenses will be taken into consideration while calculating the marginal cost. Now period and product cost. Period cost is same. In marginal costing, one underlying assumption is what? Period cost is same. Product cost is not same. Okay. Product cost is nothing but variable cost. Period cost is nothing but fixed cost. That's it. So variable cost and direct cost. So direct cost is directly related to products or services like direct material, direct labor, direct expense. Variable cost is combination of direct cost also plus other variable expenses also. Yes, sir. Now second, state basic difference. Fixed budget, flexible budget. See, fixed budget will same. It will not change. Okay. If the level of output is same, they are not changing any variations in the production, then fixed budget. Flexible budget means 50%, 60%, 80%. So if levels will change, according to the level, cost will also change. So that is flexible budget. It means in fixed budget, generally levels will not change. Always uniform production pattern is followed, and in that cost will also not change. So that will remain same. Only if there is an increase or decrease in variable cost, because of that it will change, but levels will not change here. But in flexible budget, we will prepare the budget for different levels. So the cost will increase or decrease also because of this. So here cost increase decrease will not take place in fixed budget because levels will not be there. Individually, because of external factor, it can increase decrease. Sales budget and sales forecast. Sales budget can be prepared in structured way. It incorporates quantity also, estimated quantity, estimated selling price. Okay, sale forecast is generally for units. So sale forecast is not a item which can be used in preparation of incorporated in budget. So what is reflected in budget means the things which are related to estimated. So forecast is only a prediction. Sales budget is nothing but a representation. So in short, if you want to write the answer, sales forecast is only a prediction or estimation. Sales budget is a representation. So it is represented. It is prepared and represented or reported. Cash budget, cash flow statement. Cash flow statement is a statement of cash inflow, cash outflow, or changes in cash and cash equivalent. Cash budget is receipts and payments, disclosure. So cash flow statement is prepared according to GAAP, accounting principles, or as per accounting standards. Cash budget is prepared according to management point of view, that is receipts payments point of view. Zero based budgeting, conventional budgeting. Zero based budgeting means there is no base. From zero or scratch, it will be prepared. Traditional budgeting, one base will be there. For previous data is available, from that it will be prepared. That's it. Now state only one reason: standard cost, estimated cost. Standard cost is set from management standard. Estimated cost can be used or estimated by any person. Like any departmental person can also estimate that. Cost management person can estimate that. But in standard cost, always it will be set by the standard. And a standard cost is mostly set for one unit, one particular unit. But estimated cost can be for any number of units. Standard costing, historical costing. Historical costing is only a cost accounting, which is also called as absorption costing. Standard costing is a cost control technique. In this, ultimately the objective is what? Cost control through variance analysis. Standard costing, budgetary control. Standard costing is nothing but cost control technique. In this, standards will be set, and according to that, actual will be performed. If there is a deviation, then variances will be calculated and action will be taken. Budgetary control is the forecast and estimations which are generally incorporated in one budget. Okay. So on the basis of standard only, budgets will be prepared. On the basis of standards only, budgets will be prepared. That's it. Standard hour, budgeted hour. So standard hour is generally used for time allowed to the worker, or time specifically given to worker to produce one unit or produce certain number of units. Budgeted hour can be used for fixed overhead, variable overhead. Budgeted hour can be used for fixed overhead, variable overhead. So budgeted hour term is used specifically in fixed overhead variances, variable overhead variances. Standard hour is generally used for your labor cost calculations. This is the explanation. Okay, right, sir. So with this, your cost and management accounting is completed. Now we can start the financial management part. In cost accounting, what are the questions which are not manageable or difficult? So this is manageable question. My side, I am giving yes to this question. Manageable. This question is very simple, manageable. This question is manageable if students know this point, otherwise they can struck. This question is also manageable except last control ratios question. This question is tricky question, but manageable. This is also. Last question is error in this, so student will get the marks. So costing side, I can say it is not a very challenging paper, manageable paper. Because of previous attempt question paper, students are not thinking ki this type of papers can expected. But please try to understand. Now trend has been changed. Trend has been changed. So according to that, we have to prepare. So in our classes, generally this is covered, and this is covered in ratio analysis. This is covered in ratio analysis. Second question, as it is covered in our classes, in budget, these 2 points are generally not covered in budget. This point is covered, but this is covered in direct labor. This is covered in direct labor. So this is manageable from my side. But question is covered. This question is covered. This is covered. This is also covered. And this is also covered. Okay, right, sir. But direct labor, same question is not covered, but similar to question is covered. So student will have the idea how to solve this. And this question is also covered, but breakup is not given. Semi-variable point is not possible here. So because of this, students can struck, but examiner will give the marks. Don't worry. So costing side, my point of view, it's not very difficult, manageable. Any student who is not prepared, he is not expected surprising type of questions here, that will be in trouble. Okay, financial management, already I completed 6th question. Okay. You can watch the part 1 video. Now we are starting 7th question. Compared to cost accounting, this time financial management was little bit tricky. Okay, cost and management accounting, this time financial management is bit tricky, right? So first question in financial management, section 4 we are starting, because descriptive questions only we are covering here. Which questions? Descriptive questions. So this question is on EBIT-EPS analysis. EBIT-EPS analysis. So this type of questions are already covered in our classes. Funds required, financial plan 40%. Okay. And balance debenture. It means in plan 1 40% equity, 60% debt. In plan 2 40% equity, 50% debt, 10% preference capital. Equity share capital issued at the rate of 20, face value 10 in both plans. In first plan, debenture interest is 10%. In second plan also 10% interest. In second plan, preference share dividend percentage is 15. You have to calculate indifference point and financial break-even point. Indifference point means what? Indifference point means it is a point where one EBIT level will come. According to that EBIT, if you calculate EPS, you will get same EPS in both situations. You will get same EPS in both situations. Okay. Next, financial break-even point means what? Financial break-even point means here we have to calculate the EBIT level. So according to this EBIT level, if you calculate the EPS, it will be 0. It will be 0. Okay. So at indifference point, EPS will be same. In financial break-even point, EPS will be 0. That's it. This is the explanation. We will start. Now this is part B, financial management, section 4. So calculation of indifference point. First plan, equity 40%, debt 60%. So 4 lakh, 6 lakh, because total amount required is 10 lakh. So 10 lakhs into 40%, 4 lakh. 10 lakh into 60%, 6 lakhs. Now second plan, again amount is 10 lakh rupees, but in capital structure 3 items are there: equity, debt, preference. Equity 40%, debt 50%, preference share 10%. Now number of equity shares will be 4 lakh divided by 20 rupees issue price, 20,000. Here also 4 lakh divided by 20,000, because in both plans equity is 4 lakh. Now you have to calculate the indifference point. So indifference point, how to calculate? Simple. You prepare one income statement in leverage chapter na, same you have to prepare. EBIT minus interest minus tax minus preference dividend, then by number of equity share, you will get EPS. Same statement we have to prepare. EBIT-X minus interest, first plan 6 lakh debenture na, so 10% 60,000. Second plan 5 lakh debenture, so 50,000. So earning before tax x minus 60, x minus 50, tax 25%, 0.25x, 15,000x. So earning after tax 0.75x, 45,000, 0.75x, 37,500. Preference dividend first plan not given because there is no preference capital. Second plan 15,000. So earning to equity shareholder 0.75x minus 45, 0.75x minus 52,500. Number of share 2020. So by solving this, x coming 65,000. So check this. 65,000 is coming here. So this is your indifference point. Yes, sir. 0 or 65,000 exactly. I have not checked this. So check and comment. Okay. Actually, I have not properly checked this because of time problem. This I fastly solved, right? So check this and please comment. In my opinion, this is 100% correct. No problem. Okay. Now financial break-even point. Financial break-even point means what? At financial break-even point, EPS will be 0. So how to calculate financial break-even point? Interest plus preference dividend by 1 minus tax rate. So interest is 60, preference dividend is 0, divided by 1 minus tax rate, 60,000 coming, here 70,000 coming. It means according to this level, if you calculate EPS, 0 EPS will come. 0 EPS will come. So check that. 60 minus 60, 0 ho gaya? Yes, sir. Here 60 minus 50, 10,000 coming. 10,000 minus 25% tax. Yes, sir. Then 15,000 preference dividend. So automatically this will become 0. So 0 ho jayega. EPS will be 0. So in 70,000, this is 70,000. So according to 70,000, you should calculate. 70 minus 50, 20 coming. 20,000 minus 25%. Then 15,000 will come. 15 minus 15, 0. So it means EPS will be 0 at financial break-even point. So financial break-even point 60,000 for plan 1, 70,000 for plan 2. Okay now? Yes, sir. End difference point 65,000 coming here. Yes, sir. Question number 7B. 7B is a easy question. This is also easy question. Now funds required 10 lakh, 30% equity shares of 10 each, issued at 20, 60% in debenture. This is 10% interest and 15% preference share capital. So it means 10 lakh rupees, 30% means 3 lakh equity capital, 60% debenture means 6 lakhs, and remaining is how much? 10%. 10% means 1 lakh. Tax rate 25%. We have to calculate return on equity shareholder fund when return on investment is 30%. So return on investment is what? Earning before interest and tax by capital employed. Earning before interest and tax by capital employed. Okay. So your capital employed is 10 lakhs. So EBIT is what? 10 lakhs into 30%. 3 lakhs. Now return on equity shareholder funds we have to calculate. So return on equity shareholder fund means what? Return on equity shareholder funds. So this is PAT minus preference dividend by equity shareholder fund. PAT minus preference dividend by equity shareholder funds into 100. So first we have to calculate PAT. So PAT is what? Profit after tax. So EBIT minus interest minus tax, you will get PAT. Then minus preference dividend by equity shareholder fund. Equity shareholder fund is nothing but equity capital here. 10 lakhs into 30%. That's it. So 3 lakh minus interest 60,000. So I am calculating PAT now. So this is EBIT minus interest, so 240 minus tax 240 into 25%. Okay. Then we'll get PAT. We'll get PAT. See here. Return on equity shareholder fund is what? PAT minus preference dividend by equity shareholder funds. Capital employed 10 lakh, equity 30%, debt 60%, preference capital 10%. So 3 lakh, 6 lakh, 1 lakh. Interest on debt 6 lakhs into 10%, 60,000. Preference dividend 1 lakh into 15%, 15,000. Now return on investment is what? EBIT by capital employed. So EBIT 3 lakhs coming. PAT EBIT minus interest minus tax. So 3 lakhs minus 60 minus tax, 1 lakh AD coming. Or return on equity shareholder fund, 1 lakh 80,000 minus preference dividend 15,000 by equity shareholder fund 3 lakhs. So 55% coming this. How much coming? 55%. So this is manageable question. So first question, okay, manageable, not very tough. So 12 marks, okay, bonus, easily we can solve this. Now this is question number 8A. Question number 8A. 7 completed now? Yes, sir. So this is on capital budgeting or investment decision. This is on capital budgeting or investment decision. This is a lengthy question actually. That's why examiner has given 9 marks here. And justifiable also. Okay, 9 marks justifiable. Okay, this type of questions already covered in our class also. So simple manageable question. Only one assumption can change the answers of students. That assumption is what I will explain. Wait. First, purchase price of machine is given. Working capital given. So your total outflow is 9 lakhs. This is outflow. Then useful life 5 years. Estimated salvage value. See, when depreciation is calculated, this will be considered. When cash inflows will be calculated, CFAT, this will be considered. Okay. So in depreciation calculation, estimated salvage value will come. In cash inflows calculation, actual salvage value will come. Okay. Yes, sir. So method of depreciation, straight line, tax rate, earning before tax. Here earning before tax given, so depreciation already deducted. Cost of capital, annuity factor, present value factor for 5th year 10%. So payback period, average rate of return, net present value, discounted payback period, profitability index. Chale, first we have to calculate cash inflows, CFAT. So CFAT is what? Earning before tax minus tax plus depreciation. Then say CFAT will come. Okay, this is for 1 to 4 years. 1 to 4 years. But 5th year cash CFAT will change. See. First 1 to 4 years, earning before tax minus tax plus depreciation 240. But in 5th year it will change. In 5th year, why it will change? Because working capital will release. So this will be added in last year cash inflow, terminal cash inflow. And your scrap value will also come, salvage value will also come. Actual salvage value will come here. Estimated will not come. In depreciation calculation, estimated we have to take. Here we have to take actual salvage value. Yes, sir. So here, this is the change. And one more point is also there. That is what? Actual salvage value is 1,20,000 and WDV, book value of asset, is 1 lakh in last year. Because 6 lakh rupees is the cost of asset. So after 5 years, 1 lakh depreciation will deducted. So book value will be how much? 1 lakh balance. 6 lakh minus 5 lakh depreciation for 5 years. So 1 lakh available. So 1 lakh rupees asset sold for 120. So 20,000 rupees short term capital gain coming. 20,000 rupees short term capital gain coming. So on short term capital gain, tax applicable? Yes. So we have to pay the taxes to the government. So this will be minus. You can ignore also by writing a note. Without writing note, if you solve by ignoring this, means examiner will not give marks. Or you have to incorporate this. Compulsory this is. Because after depreciation, some book value is coming. And asset is sold for more than book value. So gain is coming. So compulsory tax will be payable. So on 20,000 rupees, 25% tax will be payable. 30%, sorry. 30%. So 6,000 tax payable. So when tax paid, this is a outflow minus. So in 5th year CFAT, working capital will be plus. Actual salvage value will be plus. Tax on short term capital gain is minus. That's it. Now you can see. Earning before tax 2 lakhs minus tax 60,000, PAT 140, depreciation 6 lakhs minus estimated value divided by 5 years 1 lakh, so CFAT 240. So So here 2 lakh minus 60, 140, depreciation 1 lakh, 240 CFET, release in working capital 3 lakh, salvage value actual to 120. Now tax on short-term capital gain, sale value minus book value into tax rate. So 30% on 20, 6,654 coming. That's it. So 6,54,000 is the cash inflow of fifth year, and first 4 years cash inflows are 2,40,000. Maybe students have not considered this point. Any student who considered this point, answer is correct. See, all answers what I am discussing with you, 100% correct answers. 100% correct answer. Concept wise, 100% everything what I am explaining is correct. Now we have to calculate payback period. So year CFAT, cumulative CFAT. So this is traditional payback period. So CFAT 240, 240, 240, 240, and last year 654. Cumulative we have calculated here. Now your investment in asset is 9 lakhs. So this 9 lakh rupees is we have to recover. Up to 3 years we recovered 720. So in last year how much we have to recover? 180. So 3 years plus 9 lakh minus 720, and fourth year CFAT is 240. So fourth year CFAT 240. So 3.75 years or 3 years 9 months your payback period actually. Now average rate of return. In this question working capital given. So what will be the formula? Average profit after tax by average investment. Average investment is 1/2 into original cost minus salvage value plus net working capital. So original cost 6 lakhs, salvage value estimated, okay, 1 lakh. Because this is average rate of return we are calculating, we are not calculating cash inflow. In cash inflow, actual cash salvage value will come. So whenever estimation things will take place, estimated only we have to take. So 6 lakhs minus 1 lakh. So this is 5 lakhs. 5 lakhs divided by 2. Okay. 2,50,000. So 2,50,000 plus this is 4 lakhs. 1 lakh plus 3 lakhs. So 6,50,000. Okay. So 6,50,000 is your 6,50,000 is your average investment. So average PAT already we calculated here. PAT 140 coming. So PAT will not change. PAT will same 140 only, because all 5 years 140 only. So average also 140. So 1,40,000 by 650 into 100, 21.54%. The average rate of return is 21.54%. Now net present value. Net present value we have to calculate. So according to 10% cost of capital. So net present value is what? Discounted cash inflow minus discounted cash outflow total. So accordingly we calculated the discounted cash inflow here, 11,66,694. Outflow is 9 lakhs. So 266,694. Last year cash inflow is important. This is 654. Already we understand here. Right, sir. So net present value is 2,66,694. Now discounted payback period. So already I prepared cumulative CFAT calculation here. So outflow total investment is 9 lakh. From 9 lakh up to fourth year we recovered 7,60,560. Only how much we have to recover in fifth year? Balance amount. This minus 9 lakhs. This minus 9 lakhs we have to recover in last year. This minus 9 lakhs. So 9 lakh minus 760,560 divided by discounted cash inflow of last year. So 4 years plus 9 lakh minus 760,560 divided by discounted cash inflow of last year. So 4.343 years coming, or 4 years 4.12 months coming. Now some authors will calculate discounted payback period in different way also. What is the different way? It's in discounted payback period calculation, they will ignore release in working capital in CFAT. They will ignore salvage value also in CFAT. Okay. But most of the faculty members and authors will not follow that assumption. But some will, it can be also possible. Some authors can solve from that method also. Okay. So here I given the alternate solution also. Alternatively, by ignoring impact of release in working capital, salvage value and tax discounted payback period we can calculate. So in that case, if you ignore working capital, tax, salvage, working capital, salvage, tax, if three ignored, then your PBCFAT will be how much? 2,40,000 into 0.621 last year PV factor 149.40. According to this, if you calculate 4.935. But this is not very much followed in the practice. Most of the people will follow this only. But institute can release the answer from first method also, second also. That's why I given second also. The next is profitability index. Discounted cash inflows by discounted outflows. Discounted cash inflow 11 lakh 66,694. Outflow 9 lakh. So 1.296. 1.296. That's it. So your investment decision capital budgeting is also completed. This is also easy question, not difficult question, manageable question. See, student point of view, if I say this question is manageable, yes, manageable. Now question number 8B. 8B is also manageable question. This question is on marginal cost of capital. The marginal cost of capital means what? Whenever some extra amount is financed, for that extra amount only, what is the cost of capital? According to the weights available in that extra finance of equity debt, we should calculate this. So this is called as marginal cost of capital. For marginal cost of capital, first we have to calculate cost of equity, cost of debt, cost of preference shares, separate specifically. Then we have to use weights also. But in this question, equity and debt is given. So 20 lakh rupees required for the new project. Target debt is 33.33% of equity. The target debt is 33.33% of equity. This is not of 20 lakh. Please concentrate here. The total capital employed is equity plus debt. Equity plus debt. So equity is X. Debt is X into 1 by 3. So this is X plus 1 by 3X. X plus 1 by 3X. Okay? Understand? So this is X means this is 1 by 3X. Or in other words, if equity is 3X, debt is X. If equity is 3X, this is nothing but if equity is 3X, debt will be X. Ultimately, total capital employed is how much? 4X. Total capital employed is how much? 4X. Understand? So, X by means 1/4 is debt, 3/4 is equity. 1/4 is debt, 3/4 is equity. This is the important point in this question. If any student who started from this, answer is correct. If there is a mistake here, answer is wrong. Chali, we'll start now. Now debt 10% interest for 2 lakh rupees up to and 13% interest for next amount. So first we have to check what is the debt amount here. So debt is 1/4 of total amount. 1/4 of total amount. So total amount how much? 20 lakh. So 20 lakhs into 1/4, 5 lakhs. So in this 5 lakh rupees, first to 2 lakh rupees, 10%. Next 3 lakh rupees, 13%. This is the interest rates. First 2 lakh rupees 10%, next 3 lakh rupees 13%. This is the interest rate. Okay now? So this is 20,000, this is 39,000. So 59,000 total interest. 59,000 total interest. Yes, sir. Thereafter we have to calculate cost of debenture after tax, cost of equity according to CAPM. Because here CAPM related data is given. Yes, sir. Tax rate 30% given. Yes, sir. So according to CAPM, we have to calculate. CAPM formula is what? Risk-free rate plus beta into RM minus RF. Sometimes directly this difference is given. This difference is called as what? Risk premium. Risk premium. So directly this difference is given in the question. So risk-free rate is 5, beta is 1.2, risk premium 12.5. From this we have to calculate the cost of equity under CAPM. That's it. Now see. So let equity will be X, debt will be 1 by 3X, that is 1 by 3% of equity. So total capital is what? X plus 1 by 3X, 20 lakhs. So 4X is what? 60 lakhs. So X is 15 lakhs. It means debt portion is 5 lakhs. See, already I explained through different method also you can calculate. So your 3X will be equity, X will be debt. This is equity, this is debt. And total is how much? 4X. From this also you can calculate. That is also easy. So debt is 5 lakh, equity will be 15 lakhs. So debt is how much? 5 lakhs. So equity will be 15 lakhs because total amount is how much? 20 lakhs. Right, sir. Now interest on debt is how much? 2 lakhs into 10%, 3 lakhs into 13%, 59. But this is before tax. Post-tax required. What is required? Post-tax. So post-tax is what? Interest into 1 minus tax rate by net proceeds into 100. So interest is 59,000. Interest is 59,000 divided by net proceeds 5 lakhs into 1 minus tax rate. 8.26 coming. Now cost of equity RF plus beta into RM minus RF. RF 5, beta 1.2, RM minus RF 12.5, 20. Now marginal cost of capital 20% equity into 75% weight of equity. 0.08 cost of debenture into 25% weight of debenture. See, weight of equity, weight of debenture, total 4x na. In this 4x, equity is 3/4, debt is 1/4. Equity is how much? 3/4. Debt is how much? 1/4. So weight is how much? 3 by 4, 1 by 4. So accordingly, 75%, 25%. So marginal cost of capital is 17.065. So this is your answer. Okay. I hope this is also clear. Actually, now next question. So this is also manageable question. Now the most horrible question of entire question paper is working capital manager. Most brutal question I can say. This is not easy to solve. In this entire question paper, the most difficult question, if I can say, first of all, see from all India level, what they are saying ki cost and management accounting paper is very tough. Okay, student point of view, it can be very tough. I cannot deny that. But in some questions, we can manage the things. Some questions are time consuming. Management is not possible. That is correct. But entire 100% paper is not tough. I am not agree with that. 40 to 50 marks paper is manageable. Easily you can manage. If you add theory in that, you can plus 10 also. 40% paper is not manageable. That is a time consuming paper. But 50 to 60 mark paper is manageable. See, you are in a professional course. You can't expect same to same question from study material, same to same question from MTP, RTP, same to same question from past exam paper. No, that is not possible. If given, that is your luck. But professional exam concept will be tested. So please try to change your learning methodology. Concept based learning required. More number of questions you have to practice. And speed is also very important in exam. 40 mark paper is challenging paper. I agree with that. The entire 100 mark paper tough means I will not agree with that. 50 mark paper is manageable. Because already you are seeing now, I am giving the solutions. You see the solution, it is looking like we have done in this class. In some questions, time consumption is the only issue. Working capital is not justifiable in this exam. Very time consuming question. A lot of tricks are used in this question. So any student who attempted this wasted time and will not get marks also, will made error definitely. Because calculations are very tricky. Even I have taken approximately 35-40 minutes time to solve this question. But in exam condition, we have to solve in 20 minutes, 24 minutes only. So I am a faculty, I am taking 35-40 minutes time means think about students. Yes, sir. So time consuming question, this is not justifiable. Chaliye, we'll start. ALS Limited provides you with following information. So 1,04,000 units are there. This is completed units. Now raw material 19.6% of selling price, wages 10.6% of selling price, production overhead including depreciation 17.6%, selling price 500, average raw material 3 week, average work in progress, percentage of completion, material 75, conversion cost. Conversion cost means labor and overhead, 2 weeks. Finished goods in stock 4 weeks, credit allowed to debtor 2.5 weeks, credit allowed by creditor 3.5 weeks, time lag in payment of labor 2 weeks, time lag in payment of overhead 1.5 weeks. Cash sale and cash purchases 25%. The company believe keeping 3 lakhs available to it, including overdraft 75,000 not utilized, provision for contingencies 4% of working capital requirement. So this is 4% of working capital requirement means after calculating working capital, don't apply 4% directly. Because working capital is 100% after adding this. So before this, it will be 96%. So 4 by 96 will be required. Assume that production is carried out throughout the year, 52 weeks in a year, wages and overhead accrue similarly. Calculate net working capital using cash cost. Newly formed company. Newly formed company means there is no opening stock calculations required here. Opening stock of raw material, opening stock of WIP, opening stock of finished goods not required for newly formed company. Only closing stock possible. Only what possible? Closing stock possible. That's it. Okay, we'll start this solution now. So this is the horrible question, I can say brutal question in the examination. Any student who attempted, definitely he wasted his time. So note, for newly formed company, opening stock of raw material, work in progress and finished goods will be 0. So calculation of net working capital on cash cost basis. On what basis? Cash cost. So first we have to do working note here. First WIP, raw material, see. Total completed units are 1,04,000 plus units of WIP. Okay? Units of WIP. Clear? And this is a newly formed company. And here what is mentioned? Average work in progress, percentage of completed with respect to material and conversion cost. It means in this, what is WIP we have to use. So 1,04,000 units plus units of WIP also. It means in this 1,04,000 WIP is not there. WIP is separately given. Plus units of WIP given. So when students calculate the WIP, if they calculated on 1,04,000, finish, answer wrong. Only we have to calculate the WIP on other units. Okay? Only we have to calculate the WIP on other units. Clear? So average work in progress percentage of completion is 75% and here 70%. Understand? 75% and 70%. Clear? So your actual production is 1,04,000. Understand? Your actual production is 1,04,000. But in this 1,04,000, your closing WIP is how much? That is important. Your closing WIP is how much? That is important. So your closing WIP we have to check now. So according to the question, here they have given one point here. What is that point? The average work in progress is in percentage of completion in respect to material 75%, conversion cost 70%. It means on work in progress units, we have to apply this. On work in progress units, we have to apply this. Understand? So here work in progress units are how much? Work in progress units are 4,000 here. Work in progress units are how much? 4,000 here. So 4,000 into 75%, 4,000 into 70%, 4,000 into 70%. Into raw material is 98 rupees, wages is 53 rupees, and overhead is 73. This one. 19.6, 10.6, 17.6. Including depreciation. So depreciation is not considered for cash cost approach. Depreciation is not considered for cash cost approach. Accordingly, 98, 53, 73. So 4,000 into 75% into 98, 4,000 into 70% into 53, 4,000 into 70% into 73. So this is your stock of WIP. Okay. So here we have to write this stock of WIP. 6,46,800. Understand? Yes, sir. Now raw material consumed, wages and overheads. So actual production is 1,04,000. Closing WIP is 3,000. That is 4,000 into 75%. 4,000 into 70%. 4,000 into 70%. Okay. So equivalent units are 1,07,000, 1,06,800, 1,06,800. Cost per unit is 98, 53, 73. So cash cost is 1 crore 4,86,000, 56,60,400, 77,96,400. Okay, because we have to calculate stock of raw material also, and we have to calculate outstanding wages also, outstanding overhead also. We have to calculate stock of finished goods also. For this calculation is necessary. Now stock of finished goods produce 1,04,000. Total cash cost per unit is 98, 53 and 73. So 224. Cash cost of production or cash cost of goods produced. So this is cash cost of goods produced. 1,04,000 into 224, 2 crore 32,96,000. Now closing stock of finished goods, 2 crore 32,96,000 into 8,000 by 1,04,000. So 17,92,000. Okay, 17,92,000. Clear? So 17,92,000 is what? Your closing stock value. Clear? Closing stock value. So accordingly, this is 17,92,000. So cash cost of goods sold is 2 crore 32,96,000 minus 17,92,000. So 2 crore 15,04,000. Cash cost of credit sale is 2 crore 15,04,000 into 75%. Here it is given now. Credit percentage. Credit percentage given. So cash sales, cash purchase 25% given. Okay. So for calculating creditors and debtors, 75%. So 75%. Right, sir. Now raw materials and credit purchases. So raw material consume already we calculated here 1 crore 4,86,000. In this closing stock 1 crore 4,86,000 into 3 by 52. So 6,04,962. So 1 crore 10,90,962. So credit purchases 75% of this. Okay. Now all working notes are completed. We can start. Stock of raw material into 3 by 52. WIP already working note 1 explained. Stock of finished goods, this amount. Okay. Cash cost of production 2 crore 32,96,000 into 8,000 divided by 1,04,000 because closing stock is 8,000 units. 1,04,000, 1792. This is already explained here. Yes, sir. Next, debtors. This one 2 crore 15,04,000. Cash cost of goods sold into 75%. Okay. Into duration is 2.5 by 52. Cash balance 3 lakh minus 75,000. So 40 lakhs 44,147 is current assets. Now current liabilities, creditors. Here last working notes, credit purchases 83 lakh 18,222. Duration 3.5 by 52. Outstanding wages we calculated here 56, 60, 400 into duration 2 by 52. Overheads we calculated the overheads amount 77, 96, 400 into 1.5 by 52. So current assets minus current liability, working capital. Safety margin is given 4%. So on this 30 lakh 41,663, 4 by 96 will come. So net working capital 31 lakh 68,399. Okay. So this is your working capital requirement. That's it. Okay. So any student who is having doubt queries, I will give my number. You can contact on that number. Means directly you should WhatsApp. I will explain the things. Okay. Because this is the only analysis of solutions. In depth we cannot discuss each and everything. No? In depth we cannot discuss. Because in regular classes already you have learned this. So we cannot discuss all these points in detail. This is not possible. So only we can discuss about important areas. Understand? See, 1,04,000 divided by 52. How much it will be? 1,04,000 divided by 52. One student is having doubt here. So 1,04,000 by 52. Just 1 minute. I will check the calculations also. So 1,04,000 by 52. So 2,000 units coming here. Now one student doubt is what? This WIP is how you have calculated. So 1,04,000 by 52 weeks now. So this is month per week. So WIP duration how much? 2 weeks. So 2 into 2,000. Okay. Now it is clear. This is WIP. WIP units. 1,04,000 by 52, 2,000. 2,000 into 2, 4,000. That's why I have taken 4,000 here. See. This is 4,000. If you are interested, I will write here. 1,04,000 by into 2 by 52 is 4,000 units. Okay. Now here with this. Now finished goods also same. Finished goods also same. Finished goods duration is how much? 4 weeks. So this is 4 into 2,000. 8,000. That's it. Now understand? Yes, sir. This is the only doubt now? Yes, sir. Yes, sir. Yes, sir. Now understands. That's it. Khatam. So closing stock of finished goods also, if any student is having doubt. So this is 8,000 by 1,04,000. Here I will write. Closing stock of finished goods units 1,04,000 into 4 by 52. 8,000 units. Okay, now clear na? I hope ki students understand this point. So I explain speed normally. But if this area is not clear, I am repeating. That's it. This is the only point na? Yes, sir. Really understand, sir. Surely. So next, last and final question, B. 9B. Okay. So a garment trader is preparing cash forecast for the first 3 months. So estimated sales is given. Total sales January, February, March. The trader sells directly to public against cash payment. Credit sales are expected to be 4 times of direct sales. So he expects 15% customer to pay in the month in which credit sales are made. It means 15% of customers pay in the month in which credit sales are made. Suppose this month I sold the goods on credit, so 15% amount will come in next month. 25% will be in next month. 58% will be in next month. It means in 3 consecutive months amount is collected. In 3 consecutive months amount is collected. This month if I sold the goods on credit, 15% will be in next month. Thereafter 25% will be in next month. After that in following month 58% is collected. Suppose you have sold the goods in January month. So 15% will be collected in Feb. 25 will be collected in March. And 58 will be collected in April. Okay? Yes, sir. This is the scenario. So in this question, definitely they will give the data from November. Because November, if you sold the goods, 15% will be collected in December, 25% will be collected in January, and 58% will collected in February. Okay? So we have to prepare the budget for January, February, March. So maybe they will give the data from November. Compulsory required, that is. Outstanding balance is expected to be written off. So there is no outstanding balance here. Means immediately they are paying. Purchase of goods are made in the month prior to sales and it amounts to 90% of sales and are made on credit. Payment of this will occur in the month after purchase. It means what? Suppose this is January month. This is February month. Suppose this month sale is 10,000. This month sale is 20,000. For example, this is example. Purchase of goods are made in the month prior to sale. It means in the month prior to sale means February month sale, before only they purchase us the goods. Before February month they purchase the goods for February. Understand? It means this is sales. Okay? Now before February they are purchasing the goods for February month. It means purchases related to February they are making in January only. Purchases related to February they are making in January only. But payment is made 1 month later. So ultimately January purchases related to February you are making in January, but payment you are making in February, no? So it means February month payment is made in February month. That's it. Khatam. February month payment is made in February. Because this will come here. That's it. This is the working note. November, December, January, February, March. Total sales 640, 880, 600, 600, 800. See, it is given here. This is November, December, January, February, March. Okay? November, December, January, February, March. Now, cash sale is 1/5, already given. Cash sale is how much? Credit sale 4, cash sale 1/5. Credit sale is 4 means cash 1/5. Cash sale 1/5, credit sale 4/5. Now collection from debtor. So collection from debtor required for credit sale. So November, December, January, February, March. 512, 704, 480, 480, 640. This is your credit sale. Now 15% in the month of sale. 15% in the month of sale. It means 480 ka 15%. They collected in the same month. 25% they collected here and 58% they collected here. 25% here, sorry, 15% here, 25% here, 58% here of this. Clear? Similarly, February month, this is 25%. Okay? Sorry, 15%. This is 25%. Right? Now, 512. From this 512, if I calculate 15%, 15% will come here. Right, sir? 15% will come here. 25% will come here. Right, sir? And 58% will come here. How much? 58%. So 512 ka 58% will come here. This is 58%. Right, sir? Understand? Similarly, 704 ka 58% will come here. 480 ka 58% will come here. Understand? Yes, sir. This is easy calculation. So what is required? That I recorded here. So 512 into 15% will be in same month. So here 15%, here 25%, here 58%. Again 704, 15% here, 25% here, 58% here. 480 ka 15% here, 25 here, 58 here. Okay, this 15 here, 25 here. That's it. So after this 72, 176, 296.96 coming, 72, 120, 408.32 coming, 96, 120, 278.4 coming. Okay. See, once again I am repeating, 512, 15% will come here, right? 25% will come here, 58% will come here. 512 ka 15%, 25%, 58%. Understand? Yes, sir. Now 704, 15% will come here, 25% will come here, and 58% will come here. Understand? Yes, sir. Now 480 ka 15% will come here, 25% will come here, 8% will come here. Yes, sir. Understand, sir. Now this is collection from debtor completed. Yes, sir. Now cash budget. Opening balance given here 50,000. Now collection from debtor and cash sale. Cash sale, collection from debtor, total 644.96, 720.32, 654.4. Now payment to supplier. Payment to supplier already explained. Suppose November, once again I am repeating here, concentrate. November, December, January, February, March. Okay. Suppose purchases. Example, this is not related to question. Suppose purchases is here 20, 25. Means on what basis they are given the purchases? Means this is first they are given sales. They are given sales. Suppose sales is 70, 50, 50, 60, 80. Example, this is concentrate. Okay. Now purchases. Purchases given 90% of sales. 90% of sale. But what is mentioned in the question is December month purchases are made in November only. So December month purchase sales is how much? 50. So purchase will be here 50. So January month sale 50 na. So 1 month before they purchase. Suppose this is 40. Yes, sir. Suppose this is 40. So it means this 40 will come here. Here. 1 month prior. 1 month prior. So 1 month prior. Then this 60 will come in January. 1 month prior. This 80 will come here. This is purchase. Now payment. What is meant? Next month. This month payment will be made in next month. So it means this 50 will be paid in which month? December. December. Okay, this what is paid in what month? January. This 60 is paid in what? February. Okay. This 80 is paid in what? March. So it means if you analyze this properly, same month sales, payment is also same. Sales, payment, sales, payment, sales, payment is same. It means whatever is sale for December, payment to creditor also same. Whatever is sale for January, payment to supplier also same. Whatever is sale for February, payment to supplier also same. Whatever is the sale for March, payment to supplier also sale. Understand? So you can see here. You can see here. Okay. So what is mentioned, 90% amount is required, not 100%. So first, if you see this sales data, 640, 880, 600, 600, 800. If I calculate 75% of this, 600 into 90%, sorry. 90%, no? Yes, sir. So 600 into 90%. Okay. 600 into 90%. So this will be how much? 540. 540. This is 720. So 540 is 720. This will come in payment to supplier. This will come in payment to supplier. 90%. So 540, 540, 720. Okay. Clear na? Yes, sir. Understand, sir. Okay, don't worry. I will write the correct figures also along with the data. See, once again I am writing this. Okay. Now I will write total sales here first. Total sales is 640, 880, now purchases. Purchases will be what? 90% of sales. 90% of sales. So I will calculate this. So first is 640 into 90%. So 576. Then 880 into 90%. 792. 540. 540. 720. Okay. Now what is mentioned in the question is, this is purchases na, but this is not purchases actually. Please try to understand. This is not purchases directly. What is mentioned? See, this is 90% of sale. This is not purchases. This is what? 90% of sales. First I will write this one as 90% of sales. This is 90% of sales value. Now purchases. Purchases will be December month purchases they have made in November only. December month purchases they have made in November. So it means this 792 purchases taken place here. Okay. This purchases taken place here. This 540 taken place here. This 540 taken place here. This 720 taken place here. Okay. Now payment. Payment is next month. Payment is next month. So 792 is paid in December. 540 paid in January. 540 paid in February. 720 paid in. So this 792 paid here. 540 paid here. 540 paid here. 720 paid here. So it means very simple. Whatever is 90% sales value, same month's figure is coming in payment. Same month figure is coming in payment. That's it. So 90% of sales you have to calculate. January, February, March. Same you have to take in payment. That's it. So 540, 540, 720. So receipts minus payment. Closing balance 174.96, 355.28, 298.68. Very simple question. This is a manageable question. Easy question. That's it. So okay. Yes, sir. Now this question is manageable question. I can't say this is not manageable. Manageable. In this entire paper, working capital is a horrible question. This is very tough question. So this is not manageable in my opinion. An exam condition, time consuming. This is easy. Capital budgeting is also manageable. Okay, these two questions also manageable. So this 12 marks, this 9 marks, manageable. This 3 marks also manageable. This working capital management, 7 marks not manageable. This 5 marks manageable. Okay. Now theory questions, venture capital financing already generally you have the resources with you, so you can learn that. Okay. So whenever one venture is started, for that venture, what are the different sources of finance and methods that we have to write here in short. Okay, assumptions and criticisms of approach as to capital structure. So in Marginal and Miller we have assumptions now. That assumptions we have to write here, like no taxes, okay, investors are rational, clear, all, there is no capital structure optimal, every structure is optimal, this type of things use now. So that will be the assumptions in that. Criticisms only you should write any one criticism here. Clear? So this is not a difficult part, so you can manage here. So I am not explaining this theory, okay? Practical questions only we discuss. So from entire paper, what are the questions which are difficult in nature? Already I told you, working capital management is difficult question, and this is difficult question, time consuming question. This is time consuming question. So FM generally time consuming questions are given. So not a very tough paper, tough I can say, not very tough I can say, because when you solve the question, answers are coming with your concept. Working capital tough question, I accept that. Okay, cash budget easy question tha. Chaliye, I hope all this is perfectly understood by the student. If any student is having doubts, queries, this is my WhatsApp number. So students have to ask their queries here. Okay, you have to send the message here. I will explain the things. Only they have to message. Phone call I cannot lift here. So with this, all questions related to cost and management accounting and financial management is covered. So I am the first faculty who uploaded this video on YouTube regarding cost and management accounting, financial management for this attempt. Complete solutions have nobody uploaded so far. So you can watch and enjoy, and whatever points you want to attend the classes from our academy, numbers are available, you can contact them. See, I cannot enforce any student. It is your choice, your turn. Okay, but in our classes 80 to 85% paper we discuss. Working capital management also we discuss in detail, but that question was lengthy, so our student skip that question, I assume in that way. But remaining questions, our student cannot say ki this is new sir, manageable questions. Okay, so with that I can close the session now. I don't know what is the position of other students, but for our student they cannot challenge ki sir this is not covered in the classes. So I can say 65% paper is manageable, or on tougher side also 60% is manageable, 40% is tough. This is manageable. This I can say tough. This is my opinion. So professional exam compulsory this is. And the main problem in this question paper is what? Time. Questions are time. Time management is main problem. Questions are easily solved, but time management. Here. So all these questions, approximately 80% questions is covered in our material. Only in some places minor changes are taken place. Those changes are compulsory because 2-3 chapter questions they will mix with each other. So that is common. Okay. So any student who is having doubt, they can WhatsApp here, or academic related information they can contact on our academy numbers. Okay, with this I am closing this session for today's class. Good day and study well and achieve your dream. Chaliye.